going to get started. We are going to be discussing taxes for expats and how to keep taxes under control and reduce taxes as much as possible and avoid double taxation. My name is Jorge Fernandez, CEO of GBS Group. We're an accounting and tax firm. We do not provide any type of legal advice, and if you need legal advice, you need an attorney. But we do work with expats every year to help them make sure that they're compliant in their tax situations in the US. So this seminar is going to be specifically focused on US citizens and residents that are living abroad, living in other countries. My name is Jorge Fernandez, CEO of GBS Group, 10 years experience working with entrepreneurs, investors to establish their businesses in the US and expats that are also moving outside the US and living and working mainly in oil and gas that we've been had a privilege to work with. So our objectives today are going to be discussing what are some of the differences of taxes when you live outside the US versus when you live in the US, and how can expats save taxes specifically, and then how to plan for tax time so that we can have all of our information ready to go and prepared. So number one, big difference is there are some differences in the dates of filing. So expats that are living abroad at the time of the due date of their return can file their return on June 15th versus April 15th. Super important that this does not extend the time to pay. The deadline to pay the tax is still April 15th, but you have until June 15th to file. Now, this is super important because the payments do accrue interest. That gives you an automatic 2-month extension, and you can file a form 4868, to get an extra 4 months extension all the way to October 15th. And this is the regular extension that everyone gets. But people that are living outside the US, US citizens and residents that are living outside the US, can request an additional 2 months by mailing a letter to the IRS explaining the reasons for the extension by October 15th. And then you have until December 15th to file. So with expats, we're doing taxes all year round, almost through Christmas. But yeah, so you have additional time, and this makes it really straightforward because sometimes expats need additional time just to qualify for certain exemptions, and possibly the taxes from the other country that are due at different dates cause them to have to get an extension and not be able to file for the original deadline. So that's a lot of this items that we're going to be covering later. So you're defined as living outside the country if on the regular due date of the return, so this would be April 15th typically, you're living outside the US or Puerto Rico, and you maintain your place of work outside the US and Puerto Rico. Additionally, if you're military or naval service and living outside the US or Puerto Rico, then you qualify. If you're physically present temporarily in the US, so like you're visiting for work and then it happens to be around April 15th, but you have moved and permanently outside the US typically, that would still qualify. So super important that if you're going to qualify for these dates, that you account for the definition of living abroad. Okay, just to quickly cover general tax brackets, this applies for both expats and individuals in the US living in the US. So for singles, we have this column here. Single filers, this column here. Married filing joint, this middle column, head of household, this column. Married filing separately, also as a single filer column. And remember that you never pay a specific tax rate, you pay a combined tax rate. So your first $11,600 as a single filer would be taxed at 10%. Then the following from 11,601 to 47,150 would be taxed at 12, and so on and so forth. So you never pay an exact tax rate. So when we're talking about, oh, I'm in a tax bracket, I'm actually, that's usually the highest bracket that you pay for, that you pay any tax into. That means you've covered all the other taxes, all the other tax brackets. But not that your entire rate. So example, if I'm in the 32% category, for example, I can be at 191,955. So I would only have $5 paying the 32% rate. The rest would be paying a combined rate of 24, 22, 12, and 10 based on the maximums of those brackets. For 2024, we have our standard deductions. Um, when you're outside the US, you still are still eligible for these. 14,600 for single filers, 29,200 for married filing joint, 21,900 for head of household. Okay, key responsibilities for U.S. citizen permanent residents, specifically when this applies to all of them, but it's more important to look at when you're living outside the U.S. because you probably have foreign income, is to report your worldwide income. So there is no exemption just because it's paid in another country from U.S. tax if you're a citizen or permanent resident. Um, there are tax treaties and things that might affect this, but generally the rule is all of it is reportable. This includes salaries, rental income, investment earnings. But one key thing to note is that there is typically no double taxation. So there is always a way to use the taxes that you paid in the other country to reduce the taxes you're paying in the US. So this is something that we're going to cover in a little bit. Remember that you can be asking any questions in the question and answer box at the bottom of your screen. The report, the second responsibility is to report foreign financial assets, and this includes stocks, bonds, investment companies such as mutual funds, sometimes pensions. In in other countries, you have to report these into the U.S. and then also report the foreign bank accounts that you have. And there's some rules regarding on when you have to report these that we're going to cover in a little bit, but typically you have to report all of this. Francisco is asking, would we have access to the webinar? Yes, you will have access to the webinar, usually about 24 hours after the webinar is over. Okay, so earnings in a foreign currency. So one of the key issues with expat taxes is that you might be earning in a different currency, and depending on the country, some of these currencies have very stable exchange rates. So like euros, that are euros or British pounds that might be very stable, or we might have currencies that are significantly devalued and highly inflationary. So things like Argentina, some countries in Africa, others in Latin America, and in Asia have these issues, and it becomes slightly complicated to keep track of this to make sure that we're accurately reporting. But foreign currency, you want to any foreign currency earnings, you want to make sure that you're tracking them based on the date that was received or paid. So you shouldn't be trying to average the yearly amount. No, it's as exact as possible as we can get to the actual date of the payment you received is when we should use that date as of. Sometimes because it's difficult or very or highly fluctuating, maybe an end of month exchange rate might be um, okay to use. The IRS doesn't give specific guidelines on which to use. Their rule or guidance is use the one that makes the most sense for your business case, not necessarily the one that saves you the most on taxes, but the one that makes the most consistent sense to use for the type of income you're earning. It's also common that, for example, you might have capital gains in another country or anything like that, that the bank might provide that exchange rate if they're converting it for you to USD. So also using those amounts versus even the posted exchange rate on US Treasury or XE.com or the Foreign National Bank is also a valid one to use. Certain reports that we're going to talk about today don't use the actual daily exchange rate. They'll use an average, but these are usually reports that don't affect tax payment. They're only information. This is used for FBAR and foreign financial assets. We're going to talk about that later on. Okay, so one of the main things that saves individuals that are living outside the US in taxes in the US is paying taxes to another country. So this is what eliminates the majority of double taxation because you only pay any type of difference in rates in case that the US tax rate is higher than the foreign tax rate. Now, there's some additional things to keep in mind here that I'll discuss in a second. But very specifically, if you earn money in another country, you can apply the taxes that you paid in that country to the U.S. tax up to the maximum amount of the tax that you paid. So you cannot mix foreign income and foreign tax with U.S. income, or even with other countries' income. But you can use it against that one portion of the income. So I have an example here. If you made $100,000 in Mexico, you paid $15,000 at a 15% tax rate, and your US tax rate is 22%, you would calculate the $22,000 in US tax that you would pay minus the 15,000 you would pay to Mexico, and you would pay the IRS the difference in the 7,000. And this is a very simplified example, but this is typically how it'll work in the grand scheme of things. Okay, your next responsibility is reporting bank accounts outside the US and foreign financial assets. So there's some rules around when you have to report these, and some of these rules vary because some financial assets have additional reporting requirements apart from these general ones, and those might require reporting even if they have no threshold, if they don't meet a threshold, even if they're just a few dollars. Um, so bank accounts outside the US, this is any type of depository or investment account that you have authorized signature or are a holder. So this would include accounts for family members or businesses. If the maximum aggregate balance of the accounts was more than $10,000 at any time of the year. So let's say I have 10 different bank accounts outside the US and I have $1,000 only, and I transfer $1,000 from each one of those accounts in sequence at any time during the year, the maximum balance for each one of those accounts was $1,000. I have to aggregate that maximum balance. So my maximum balance of all the accounts was $1,000 each. I have a reporting requirement for all 10 accounts. Um, so it's super, super important to keep in mind, especially if you sign on business accounts. Those business accounts will most probably very rapidly surpass those limits. And then that causes you to have to also report your personal accounts and all the business accounts that you sign for. Then we have reporting financial assets. And financial assets are typically stocks, bonds, investment companies, pensions, trusts, um, CDs sometimes. Sometimes if CDs fall under the reporting bank accounts, but sometimes CDs fall under the reporting financial assets. And there's also some overlap over these reporting requirements. That might cause you to need to report it twice, but that's at the end of the day very simple. And super important with any of these reporting requirements that I'm mentioning right now specifically, they do not cause taxation directly. If you earn income from these assets, yes, that will be taxed, but reporting them themselves does not cause tax. So you have to report financial assets. As I mentioned, there are certain types of assets that don't apply these thresholds, but for sure you have to report all your financial assets if at the end of the year, foreign financial assets, if at the end of the year the aggregate value is 200,000, or if married 400,000, if at any time of the year they reach 300,000 in value or 600,000 in value married. So this is super important to keep in mind. And this is our foreign financial assets. If they're in a U.S. bank account or a U.S. investment portfolio, you don't have any additional requirements apart from what your U.S. bank is already doing on your 1099, and other reporting that they do. Penalties for not filing FBAR or foreign assets. So FBAR is the bank accounts reporting, and the penalty there is $10,000, and that could be for per account, or up to 50% of the account's value. And the reports for the financial assets are usually $10,000 per asset for failing to file the report. This does not mean reporting does not mean you have to pay taxes unless income was generated or realized. Typically, the same rules for interest, dividends, and capital gains apply as a U.S. asset, as if they were a U.S. asset. So you would pay on interest, dividends, capital gains based on the gain or loss of it. There are some exemptions, but generally they work very similarly. Then we have the foreign earned income housing exclusion. And this one's something that's very powerful to reduce taxes for expats, because you can exclude up to 126,600 per person in salaries. So this would be double for both spouses are working outside the U.S. Um, And there's some rules with regarding to how to claim this. So you have to meet one of two tests, either the physical presence test or the bona fide residence test. To meet the physical presence test, you have to be in a foreign country for 330 out of 365 days of the year. So that means you can only be in the US for 35 days. These days do not have to be continuous, and they also don't have to be in the same tax year. So, for example, I don't have to count the 365 days as January to December. I can count June to June, August to September, whatever helps you meet the 330 days works. Now, if they meet in two separate tax years, I would have partial exclusion in each year. So I would divide this amount by the amount of the days that I complied with during the 2024 tax year and include that amount of the exclusion in my 2024 taxes. And then I can already qualify for the amounts for the following year. So I would already qualify for the exclusion for those for the following year. This 126,600 is a 2024 amount. It gets adjusted for inflation every single year. Then we have the bona fide residence test. And this is a little bit more difficult for, in most cases, to qualify because number one, we have to be in a tax treaty country. So there's about 70 countries that have a tax treaty with the US. And these countries have some rules about how to establish residency. And if you're able to comply with those rules and become a permanent resident of that country for tax purposes, then you have a bona fide residence and you can claim the Form 255 exclusion for the foreign earned income without having to have the strict 35 days. So that's one of the differences there. Individuals that are kind of like being treated as digital nomads typically can't file for physical presence because, can't file for bona fide residence test because they won't be in the country long enough, but they can claim physical presence test. And then we have the housing exclusion. So if you qualified for the foreign earned income exclusion, and you have housing income and expenses, you can include these in you can exclude these from your income based on some rules. But first, you have to qualify for the foreign earned income exclusion. So you can deduct actual expenses for rent, utilities, property insurance, and furniture rentals considered paid by employer-provided amounts, up to 37,950. There are some adjustments based on certain countries, but for purposes of this seminar, we'll just use the 37,950. So you can get the key here is that you should get these amounts separately stated on your pay stubs independently if the employer pays them directly or if you're paying them after your employer pays you. So if your employer provides you a $20,000 housing allowance, for example, this ideally would be separately stated on the pay stub as a housing allowance, and then the employee pays $19,000 in rent. You would be able to deduct the $19,000 from your income. You can't exclude the 20,000 because you only actually paid 19,000. If there were maybe utilities or property taxes, you might be able to get to the extra $1,000, but you would at least be able to deduct the 19,000. But the key here is that you need to make sure that it's separately stated on your pay stubs, or at least in some kind, maybe not separately stated on each of your pay stubs if there's some kind of tax situation over there in the other country, but maybe in your employment agreement, get it documented by your employer that these amounts are what are the amounts meant for housing expenses. Okay. And then the next situation is that if you're living in a state, if you were previously living in a state with income tax, which would be not any one of these states here do not have income tax at the personal level. The following states do have income tax at the personal level. If you were living in any one of these states, you're going to want to try and figure out a way to comply with the state's rules to get rid of the tax residency for that state and change your tax domicile. Some states have pretty strict rules on that make it difficult to lose residency status in the state. You can be a U.S. resident without any residency status in any state. So that's something to keep in mind. The important thing here is to make sure you comply with the rules for that state to lose so that you lose residency. Some states have what's called a permanent abode rule. Um, and this is usually one of the most lax rules they use to try to keep you as a resident. So for example, if you have a house that you only use certain times of the year, but you keep it permanently and don't rent it, and it's only for your use, you might be considered a resident of that state if you can't provide residency in another state that you're living in. So that's something that's to keep in mind and check on a case by case basis with your accountant tax preparer to make sure that you avoid having to pay taxes at the state level because that can add up to and here we have some of the tax rates. That can add up to 5% in some states. It's probably about average, and then it goes up to 10 and at 10, almost 11% or 13% in California and New York. So definitely finding a location that either has no state income tax to maintain your permanent residence, or losing the residence in your other state and not establishing it in a new state would be beneficial. Then we have Social Security, taxes and pensions, so 401ks and pensions. So this kind of will vary based on the relationship of with the employer. The relationship with the employer will determine how Social Security in the other country taxes are paid. So if you have to pay Social Security taxes in the other country because there's no agreement or rule, then you do have to check if there's a totalization agreement with that country in the US. There's probably around 90 countries that have totalization agreements with the US, and the rules vary, but they'll allow you to either eliminate the tax in the other country, or use the tax paid in the other country to credit it to your Social Security earnings for when you retire and claim Social Security after you're 62. Remember that Social Security is based on working at minimum of 40 quarters as in the US to qualify. That's the first thing. And then they use your highest 35 years of income to to calculate the amount that you're going to be paid. So that's something that's super important to make sure you attribute if you want to be able to claim Social Security and make sure that it's properly calculated for you. Um, and then pensions such as 401k and IRAs can be used by people who work in the US and return home. Sometimes the employers allow you to continue to um, contribute to this through the US employer. There are rules regarding this. If you're required to contribute to a foreign pension, usually the employer will take these matters into account, but super important to make sure that you're invested in funds that don't trigger foreign reporting requirements because you might have to we've had cases where the individual, a US citizen, is paying into a foreign pension, and that foreign pension is invested in investments that are required for the IRS requires payment and reporting in not favorable methods. So when preparing for tax time, our recommendation here is number one, to identify when you'll have your foreign tax return done. So if you're having to file a foreign tax return, and that will have a deadline, that will have a date on payment. Super important that you know when that will be, because until you have that, you don't really know your exact tax amount for the foreign country, and we shouldn't file in the U.S. because the amounts that you paid for estimated tax or withholding amounts aren't accurate until they are finalized on a return um, in the other country. Some countries might just say that the withholding amounts are your tax, and if as long as that's the case, that's also okay. But that's not usually the case. You should track your days spent in each country if you plan to meet the physical presence test, especially if you plan to meet the physical presence test based on a non-calendar 365 days. So like if we're meeting it June to June, we might be required to file an extension because you cannot file until you actually qualify. So extending that would be the necessary to be able to qualify for the physical presence test. If, for example, if I want to qualify June 24 to July to May 25, that 12-month period, 365 days, I have to wait until after that to file my return. So that's something super important to communicate with your tax preparer early, and then review your residency state requirements for termination, so that you can try and terminate that if possible, and keep foreign assets to a minimum. You want to make sure that you keep um, as much things in the US as possible to reduce your reporting requirements, because that will save you on tax preparation fees and headaches with regards to um, foreign tax calculations and things like that. So definitely try and do that. And that kind of gets us to the end of the seminar. If you have any questions, I'm available to answer some of them right now. And if you need help in your taxes, we're also here to help. And we'll leave it open for questions for a few minutes. And as I mentioned previously, the seminar will be is recorded and will be provided to you via email in about 24 hours. Okay, if we have no questions, let me see if there's any notes that I want to add. Uh, no, I think we pretty much covered everything. Um, Great. Yes, moving to a different country is definitely a challenge, and you should plan around it. Also, if you're moving to another country and not being transferred by your company, it's also something that you want to check with local um, counsel, accounting and legal counsel on what you need to be able to move there. So, what are the taxes that you're going to be paying there? How can you minimize the taxes that you're going to be paying there? And things like that. Because it's also it's a two-sided thing, right? So we're talking here about U.S. centric taxes when there's also the other country, right? And for example, we've had situations where things here in the U.S. might be lower tax than in the other country or higher tax, or the other way around. We've also had cases where certain types of income are exempt in the other country, and then here they're taxed. So those types of things are things to keep in mind. So pension income is taxable in the US. I do not know if Spain will tax the pension income. So that's something to ask Spain counsel for. When we're talking about pensions, right? So we're talking non-Social Security. Social Security has, if you're receiving pension from Social Security, there are some additional rules that exclude Social Security earnings from taxation based on your total income. So that is something to keep in mind with regards to U.S. taxes specifically. Okay, cool. If we have no other questions, we're gonna end it here. Can you please repeat how the double tributation treaty? I'd like to know about, specifically about Venezuela. Um, so typically there is no double taxation under most circumstances. So you end up paying what you end up paying in one country, you take as credit in the U.S. That's typically how that works. There are tax treaties that affect this. The tax treaties are also based on specific types of income. So dividends and dividend income is different than interest and actual salaries and pensions. So that's something to keep in mind with regards to tax treaties. But typically, you won't have a uh, an amount that is due to both countries duplicating the same tax. So you might have differences in rates. So like if the tax rate in one country is 15% and in the US it's 20, you might pay the difference in 5 to the IRS. But you won't pay double. Yes, so you should. So if you're moving to another country and specifically if you're not doing it through an employer, you should be getting counsel in the other country and in the US, typically separate. No, we cannot help with Spain taxes. We might be able to refer you to someone. I'd have to double check, but no, we can't help you directly with Spain taxes. We can help you with how Spain taxes affect the US. That we can. Awesome. Great. And if you have any other questions, feel free to email us info@gbsgroup.net, or call us at 954-659-8835 and follow us on social media. And yeah, thank you so much for your time. And as I mentioned, the seminar is recorded and will be sent to you within 24 hours.